Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today is Mark Burgess, Deputy Global Chief Investment Officer and Chief Investment Officer EMEA. And we're going to discuss some of the key themes driving markets. These include the ongoing trade war, the outlook for fixed income, European corporate earnings and emerging markets. Mark, let's start with the US. Trade skirmishes initiated by the US administration earlier in the year have now turned into something of a full-blown trade war. What are your thoughts on trade and the implications for the global and the US economy?
I've got lots of thoughts on that. I guess my first thought is a concern that the leader of the free world thinks the trade war is a war you can win, because I think the best outcome would be that you lose less than other economies. But clearly, righting the wrongs of trade imbalances is an agenda for the Trump administration, and they're putting in place tariffs as a fairly blunt instrument to rectify that. We've talked in some of these previous meetings about the strength of the global economy, and we've seen a relatively unprecedented bout of synchronized global growth over the last couple of years. And I guess what would concern us is that tariffs have an ability both to slow that down, introduce some inflation into the system, because clearly after all you're increasing prices or decreasing profits, one or the other. But thirdly, introduce a degree of risk reduction in terms of investors' appetite to take on risk. So as this escalates potentially, and it's clearly a very fast-moving issue, different things coming out on a daily basis. As this escalates, this has the potential to introduce a degree of skittishness into the global economy and to financial markets that is unwelcome and unwarranted, and we need to watch that very closely, I think.
Coming at the same time as fiscal reform as well.
Absolutely. So clearly you've got, at the same time you've got a kind of foot to the floor policy coming out of the United States with fiscal stimulus at sort of late stage growth part of the cycle, with unemployment heading towards 3.5%. It just feels a bit unbalanced, and I think the introduction of tariffs have the potential to unbalance that even further.
And moving on to emerging markets now, and has the region stabilised, and what are the risks from here?
Well, emerging markets have taken a bit of a battering. One of the outcomes of all of this is as a result of stronger US growth, and also as a result of a kind of flight to safety, we've seen a stronger dollar, and that has been pretty bad news for the emerging markets. Many of the emerging markets run current account deficits, and they've had to raise their interest rates to stabilise their currencies as the dollar has strengthened. That's undermined growth, and again has taken has really introduced a degree of nervousness into the emerging markets. Now, in the last couple of weeks, the dollar has stabilised, and emerging markets have settled down. Valuations look pretty attractive. I have to say, there's a big consensus underweight out there now in the emerging markets, both in equities and fixed income. So I think it's an area of interest. But were we to see the tariff issue escalate, I suspect you'd see some more dollar strength, and I think the pressure would be on the emerging markets again. So it's not over yet, but for now, things have calmed down.
In Europe now, we're expecting corporate earnings growth of about 10%. How are valuations right now, and are you still positive on the region?
We are still positive on European equities. The elephant in the room remains tariffs, because many of the world's best and largest exporters are European companies, and Trump is targeting a number of industries. The auto sector, for example, is something that's in his crosshairs. Now, today, right now, it feels like the pressure's off a bit. And I think European equities can make some headway, but were tariffs, without wishing to keep coming back to tariffs, were tariffs to be introduced on a cross-section of European industries, I think that would weigh heavily on European markets. But fundamentals, earnings revisions are pretty positive. I think the growth outlook remains supportive. I think European equities look okay.
And in the UK, the politics around Brexit, of course, are uncertain to say the least. How is the domestic economy faring, and what are your expectations as we move towards that Brexit deadline?
Well, I think the government have limped towards the summer recess and probably are taking a big sigh of relief as we speak, because it's been a pretty tumultuous couple of weeks for UK politics. The Brexit negotiations are clearly ongoing, but are very difficult. The factions in the Tory party, where you've got hard Brexiteers and Remainers trying to form a consensus opinion which they can negotiate with the European Union, is making life very, very difficult. It's undermining the Prime Minister's negotiating position, and all of that weighs heavily on the UK economy. At the margin, the things that we look at would suggest that the UK economy continues to weaken. That's not going to be helped by the fact that the Bank of England appears set on raising interest rates next month, which from our perspective would seem unnecessary. So it's not great. Now clearly we'll see a regrouping in the autumn as Parliament comes back and the Brexit negotiations kind of get back underway again. But I think it's going to be very difficult to find a position where Parliament and the UK majority will see a sort of way forward from a Brexit perspective. So I think that against that backdrop, I would expect the UK economy to continue to weaken.
Okay. Now, in core fixed income markets, the yield curve is flattening, and that's something that's historically happened prior to recessions. Should we be worrying about a sharp slowdown soon?
It's certainly a curious feature of financial markets. As you say, a yield curve flattening and then inverting has historically been a precursor to recession. We don't think that's the case currently. What we think that is saying is that the interest rate rises we're seeing coming out of the US and the withdrawal from QE that you're seeing slowly around the world is taking inflation out of the system, and as inflation comes out of the system in the short term, that is sort of deflationary in the long term, and I think that's the bond market recognising that. So we've seen long yields fall, and as you say, the yield curve flatten. So I don't think that's a recessionary risk. I think it's just the market saying inflation is not a longer term concern.
Mark, thanks very much.